Good evening, everyone. Thank you very much for joining in. So I know it's been almost 5 years. We started this masterclass series, and again, the whole idea of this masterclass was I attended couple of such sessions before somewhere, and I just felt in love that we pick up one topic and there is a lot of noise, lot of data around everything, but we want some real knowledge, real stuff to come in, and that would require some classroom kind of environment, workshop kind of environment where we can actually learn about something. And that was our intent to kickstart this masterclass series. And I'm very happy to share that it's been 5 years now. We've been trying rigorously to maintain the consistency to have this session every month. Yeah, some months we have missed, but I think largely we are trying to have this session every month. That's the update. Again, the feedback has been incredible, and we are just trying to make sure that we pick up a relevant topic, which is very useful for investors in their financial wealth creation journey. Yeah. So let me just set up the context where we are today. So as we step into the last quarter of 2025, the investment landscape remains as dynamic as ever. Global growth is uneven with constant headlines on geopolitics and tariffs. While the US economy soft lands under tighter policy, India continues to stand out as one of the very few large economies sustaining mid single digit GDP growth. Corporate earning momentum has been very good post COVID surge, but still resilient, supported by steady manufacturing and capex revival. So again, we have seen green shots given by government in terms of tax benefit, GST benefit, as well as interest rates coming down. All these is building India into a very beautiful macro story as we talk. But if I look at last 1 year, India has underperformed major markets. So from that point of view, US, China, Europe, Japan, all these markets have done well in last 1 year, but India has not performed well. Largely, currency has not moved. Tariff worries were there. So there were a lot of headwinds which were there, and last 1 year again maybe the valuations were very rich, so we have seen good amount of correction happening in the market. So again, equity markets have been oscillating. There was a lot of optimism, valuation fatigue. Sector leadership is changing from manufacturing to financial towards energy transition, defense, consumption. So in this environment of high valuation, shifting global flows, and changing alpha sources, investors increasingly need structures that combine institutional grade research with tactical flexibility and tax efficiency. And that is where we thought of a topic for this masterclass, because at time couple of months back, a lot of fund houses in India launched their SIF, the Strategic Investment Fund, which has been approved by SEBI, and we wanted to explore whether it fits in the goal-based portfolio which our clients are looking at. So that was our thought process behind this masterclass. So without much ado, I'll give introduction about our speaker who is going to help us understand this topic well. So it's my privilege to welcome Mr. Gaurav Mehta, CFA, Head of SIF Equity at SBI Funds Management. Mr. Mehta joined SBI in November 2018 as equity analyst, later managing several flagship equity schemes. In October 21, he was appointed CIO Alternative Equity, leading the equity portion of the PMS business. Since July 25, he has taken charge as head SIF Equity, spearheading the equity investment strategy for Magnum SIF. SBI pioneering vehicle under the new SEBI Strategic Investment Fund framework. A CFA charter holder with over a decade and half investment experience, Mr. Mehta brings together bottom up discipline, macro awareness, and data driven multi style approach that sits perfectly at the intersection of active management and structural efficiency. So today he will help us decode how the SIF structure brings the gap between a PMS and AIF frameworks, how it enables greater flexibility, transparency, and tax alignment, how SBI Fund Management is leveraging its deep research platform to build this SIF strategy for investor. So again, we wanted this session to be very interactive. We would love to have you stand as investor, what you are thinking, what concerns you, and how familiar you are with newer investment vehicles like SIF. So discuss this, we have a small poll. Gaurav, before we let you in speak, we have a poll to give you some idea about what our attendees are thinking. So, team, can we run the poll, please? Yeah, you all can see a poll on your screen. If you can just uh, do the selection. So we have just 30 seconds. Request everyone to please fill this form. Poll on your screen. Yeah, done. Yeah. Dinah, can we run the poll results, please? Great. So, Gaurav, these are some of the results you can see on the screen. I'm sure this is going to be helpful for you to make this session more powerful. Yeah. You want me to read out the answers?
No, no, that's okay. I'm just sort of reading it myself.
So, which vehicles do you currently trust most for long-term wealth creation? Mutual funds, 71% think so. 18% feel PMS, and again SIF, I don't know, 12% people feels it could be a great structure. Uh, when you evaluate performance, which return do you focus on most? Post-tax actual return, net of fees but before tax, or gross return? 65% feel post-tax return. Again, that's a very interesting benefit of SIF, so I'm sure Gaurav will touch on that. Again, compared to PMS, what have been your biggest hesitation? High churn leading to heavier taxation. That is one of the problem statement investors feel in PMS right now. Yeah. How would you describe the current Indian market environment? I think it seems the house is divided. Nobody has a there's no consensus there. Yeah. So I think now all yours, Gaurav. I think you can take it over. Thank you very much.
Perfect. No, I think that context setting was extremely useful. So what I'll do is I'll share my screen. I have a few slides to talk about, but as you rightly said, let's keep it interactive and if there is any sort of question, we should sort of discuss that as we go along. Or up to you. I mean, do you want me to just run through the slides first and then take the Q&A? Whatever works.
Yeah. I think you can first give us an overview of this. That will be helpful, Gaurav.
Understood. Perfect. So let me do just that.
So general concept of SIF, maybe evolution of this and why SEBI thought of it. Maybe all those will be very useful for us. Yeah,
Perfect. You can see the screen now, right?
that's correct. Yeah.
Perfect. So let me start at that as to how SIFs are different from mutual funds and even versus PMSs and AIFs. Uh, and anyways, I mean, before I talk about all this, let me just take you through a slide that sort of gives you numbers around this. Uh, 1 second. Yeah. So I think this is just a simple comparison between SIF, MF, PMS, and AIF. And let me, start from the bottom. Versus a conventional mutual fund, the difference that SIs bring to the table from a regulatory point of view is that you're allowed to go short here. And in general, the use of derivatives is more flexible than in mutual funds. Now, what I mean by that is when you think of a mutual fund, let's say an equity scheme in a mutual fund, it's largely buying stocks and hence, taking a unidirectional call bet, which is that buying things. So if the market goes up, you make money. If the market doesn't, then maybe you don't. So when you think of a mutual fund product, a large part of the returns are a function of what the overall market does. And obviously, over and above that, there is a degree of alpha that you create. But let's say the fund delivers 17% returns, the index has delivered 15% returns, then 15% out of that 17 has come just because the index has risen. The remaining 2% is what you call alpha. Right. So to that extent, a large part of mutual funds are actually beta products where they are more a call on the market direction with some degree of alpha coming in. Versus which in an SIF, because you can go short, you can also benefit from markets coming down. So, for example, you may not own a particular stock, but if you think that that stock will decline, either because it's expensive or fundamentals are deteriorating or whatever can be your reason, then you can short that stock in futures, and as the stock price declines, you actually benefit from that decline in stock prices. So that's something that you can do in SIS, but you cannot do that in mutual funds. Obviously, there are limits to how much you can do it. You can do it up to 25% of the portfolio, and there is no leverage allowed, which is to say that your gross exposure cannot exceed 100% at any point in time. So, for example, if the AUM of a scheme is 100 rupees, and if you have used 25% shorts, which is the maximum that's available, then you're only left with 75% remaining portfolio to be used for longs. But even in this example where you have 100 rupees, you've used 25 for short, 75 is long. If you look at the net exposure of this portfolio is just 50, because 75% of your portfolio benefits from market going up because it's long on the market. 25% of your portfolio is short, so it benefits from market declining. On a net basis, 75 minus 25, 50% is your overall exposure to the market. And in that sense, your ability to generate returns, which are, I won't say independent, but which are relatively less dependent on the markets than in a mutual fund, is higher in SIFs. And similarly, when you think of options, you can do a lot of other stuff, which there's a lot more flexibility on how you use options in an SIF versus a mutual fund. For example, writing calls, buying puts, and a lot of other things that you can do, which you cannot do, or you can do on a very restricted basis in a mutual fund. So I think that's the big advantage. You can use derivatives to create risk reward outcomes which are not necessarily dependent on just the market moving higher. And to that extent, your ability to create returns which are uncorrelated to market returns is higher than in mutual funds. Hmm. Now, when you think of other investment platforms apart from mutual funds, in general, PMSs also don't do derivatives, they don't short and so on. But AIF is a vehicle where you can, let's say, go short. The limit on leverage is higher. So here you cannot exceed 100% in terms of gross exposure. In an AIF, you can go all the way up to 200% in terms of gross exposure. So to that extent, the use of derivatives is even more flexibly allowed in AIFs. But then the problem with AIFs is, from a taxation point of view, anything that you do on derivatives in an AIF gets taxed at the maximum marginal tax rate, and the fund pays that tax at whatever 39% or so. Versus which an SIF is like a mutual fund where all your transactions that happen within the wrapper of the fund, the investor has no tax bearing, right? So as a fund manager, I can be buying, selling, going long, going short. But whatever I do within the fund, the investor doesn't have any direct tax implication. The investor only pays the tax when they redeem. And then depending on, just like a mutual fund unit, depending on whether it's equity, whether it's debt, whether it's long term, whether it's short term, whatever is the applicable tax rate for that asset class, you pay that on your redemption from the scheme. So whatever happens within the wrapper of the fund has no tax implication. And I think, in the poll, I did see that that was one of the key concerns that investors, I think there were 2 points which were very clear. A, people are evaluating returns not just on gross basis, they are evaluating it on a net post-tax basis. And to that extent, this tax efficiency matters quite a lot. And B, I think what I also saw was that the key deterrent as it came with respect to PMSs, etc., was the high tax incidence that you have on churn. Versus which here, practically there is no implication for investor on the churn that happens within the fund, and hence tax is significantly more efficient. And then I think the third thing that I saw there was that people prefer mutual funds because of the transparency, the better regulation, more liquidity, and so on. And I think all of those features, all of those benefits of a mutual fund structure stay as far as an SIF is concerned, given that it is a carve out from the mutual fund space itself. So to that extent, better use of or more flexibility on the use of derivatives, including your ability to go short, which is an advantage versus mutual funds. But at the same time, retaining the transparency, the regulation, the liquidity, the tax benefits of a mutual fund. So I think that in a way makes it the best of both worlds, a good combination of what you see in alternatives platforms versus mutual funds. And I think that flexibility is what excites us so much about SIs, and that I think will help asset managers create risk reward outcomes which are very different from the existing suite of products. And finally, to just complete this slide, you know that from a minimum investment point of view, you're required to put 10 lakhs across SIF schemes of a particular AMC. And at this point, if we have started with one scheme, that means that the investor will have to start their journey with 10 lakhs in that scheme. Tomorrow, let's say SBI or Magnum SIF by SBI, if we have three different schemes, then the investor can start their journey by putting 4 lakhs, 4 lakhs, 2 lakhs, or some combination thereabouts, such that they have a total of 10 lakhs invested within the SIFs of Magnum SIF offered by SBI Mutual Fund. And again, this 10 lakh requirement is significantly less cumbersome than PMS and AIF at 50 lakhs and 1 crores respectively. So I think that in a nutshell is what SIFs are. They are mutual fund structures, but with more flexibility on use of derivatives, but retaining the same benefits of taxation, liquidity, regulation, etc., as comes with a typical mutual fund investment. Now, from a regulation point of view, the SEBI has allowed 7 different categories of SIFs. 3 equity, 2 debt, and 2 hybrid. Any AMC can launch exactly one product in a particular scheme, no more. So to that extent, any AMC can launch at max a total of 7 SIF strategies, given the current regulatory construct. If this changes, but at this point, these are the 7 categories that are available to invest in. Just for the sake of completeness, if I quickly talk about these categories, there is an equity long short category, which essentially means that there is no constraint here with respect to either market cap or sector. You're unconstrained with respect to what you go long on and what you go short on. There is a second category within equities, which is called X top 100 long short. And here the regulator is saying that more than 65% of your assets have to be outside of the large caps, right? Outside of the top 100 companies. So in a way, this will be long short, which will be more skewed towards mid and small caps. And to that extent, this is bound to be a bit more aggressive in terms of its risk reward. The third category that you see here is sector rotation long short. And here again, the regulator is saying that you can have a maximum of 4 sectors in the fund. So which means, if you're using that 25% short leeway that I discussed earlier, and that 25% max shorts is something that is true for all of these categories, and which is why if you look at the nomenclatures here, all of these categories are termed as long short funds, because the underlying philosophy around use of derivatives and use of shorts, etc., is exactly the same. So I was talking about the sector rotation long short, and here the regulator has said that you can have a maximum of 4 sectors in this fund, which means that if you've gone short on one sector, you can at max be long on 3 sectors or less. So to that extent, this is going to be a very concentrated bets on sectors doing well and sectors underperforming and so on. And that in itself will mean that this will be an aggressive product as and when it comes. I'll not talk about the two debt strategies. They are again, pretty obvious. One is a unconstrained debt long short, and one is a sector debt long short, just like equity sector rotation long short. And then within hybrids or within asset allocation, there are two categories. One is an active asset allocator long short, where you can use different asset classes, including commodities, REITs, and InvITs in a very liberal fashion. And then there is a there is a hybrid long short. Hybrid long short category, which is where we've launched our first fund, is where you largely invest between equities and debt. So there are the two asset classes for you to invest in. And what the regulator has said is that you have to have minimum 25% in equities and minimum 25% in debt if you're investing in this category. So which means you can range from 25 to 75 on equity and 25 to 75 on debt, depending on how you structure the product. So I think those are the seven categories that are available. And as I said, we are starting with the hybrid long short category, where equity and debt are the two primary investment avenues. Within that 25 to 75% band, in fact, I can take you through the asset allocation of this product. We are choosing to, yeah,
Gaurav, before you get into specific, can you go to that slide again? The various different
yeah,
allowed by SEBI. So,
yes.
can you tell us which one would be competing with your long only PMS or AF strategy? Which strategies are going to compete with that?
So when you think of PMSs, they are essentially, and again, there is no definition to how a PMS is supposed to be run. But in general, when you think of PMSs, they are largely focused on small caps. And I think one way to think about this is that as mutual fund AUMs grow in size, their ability to play a lot of small caps and micro caps diminishes because of the size of their assets. And PMSs in that sense have uh, tried to explore or exploit that opportunity of investing in relatively smaller companies, because size in most PMSs is still small. Now, when you think of the various categories here, the X top 100 long short category, for example, where you are essentially required to be largely in mid and small caps, and again, there's no limit to how much small caps or mid caps or micro caps can you own here. I think this is a category that will directly compete with PMSs, but again, it's just one of the several categories, and at some point, this will have uh, AMCs may decide that beyond a certain AUM, they don't want to continue scaling up. We, for example, our mutual fund strategy on, the small cap strategy on the mutual fund platform, we haven't been accepting lump sums there for at least 7 years now, if not more.
Right.
So to that extent here also at some scale, AMCs may say that, okay, to do justice to the small cap bias or the mid and small cap bias of the portfolio, let's restrict it to a certain AUM. But to answer your question, yes, this is one category that can potentially compete with PMS. Now, when you talk about AIF, and I think again, different AIFs are run differently. There are several long only AIFs, which essentially are, like mutual funds, long only mutual funds. But then there is also this category of AIFs called long short funds. And when you look at long short funds, which are essentially trying to, go long certain stocks, short certain stocks, and trying to sort of play on a relative basis. Um, and then, AIs obviously come with a disadvantage. So I think when you think of that long short strategy, where essentially you're trying to target, maybe if not purely absolute returns, but returns with a relatively low dependence on market, returns with a relatively low variability, and so on, then I think depending on how you structure the different categories, you can have potentially an equity long short competing with a strategy like that, or even a hybrid long short, if depending on how it's structured, can compete with an absolute return oriented or a market neutral AIF kind of a strategy.
Sure, sure. Sorry to intervene. I just thought it was relevant at that time, so I shared. You can continue the way you want to share here, please.
Perfect. So I think that was a brief on how SIFs are different from mutual funds and PMSs and AIFs. And then I think you were right to sort of point out, are there any categories that directly compete with those? And again, just to round up that discussion, if you think of sector rotation long shot, for example, uh, the closest proxy that I can think of is these business cycle funds on the mutual fund platform. But again, business cycle funds have no restriction on how many sectors can be represented there, right? So practically, you can run a very diversified portfolio even within business cycle funds on the mutual fund platform. Versus which here, as I said, you have a restriction of only four sectors. So this sector rotation long short fund will be a much more, a sharper and focused approach towards identifying right sectors. And if you get it right, you can just sort of make a killing. If you get it wrong, you can yourself get killed. So to that extent, it's going to be more aggressive. But I think this is where you can have a much sharper sort of a focus towards identifying right sectors and trying to generate returns out of that. So I think with that quick background, let me talk about the hybrid long short fund. And from our point of view, and even before I come to the asset allocation, let me just talk you through a simple slide where when I uh, go to meet people on SIS and, whenever we collect any market feedback, uh, and maybe that is a question that you could have included in the initial questionnaire. Is that what is the perception of investors around SIFs? Are they supposed to be aggressive products or conservative products? And in general, the response that we get is that SIFs use derivatives more flexibly. And because derivatives are riskier instruments, so to that extent, SIFs should be for aggressive investors. Right? That's the general perception that SIFs use derivatives. Derivatives are risky, so SIFs are aggressive. But I think, we all know that derivatives can be used to enhance risk. They can be used to mitigate risk. Think of how a corporate uses derivatives, for example. They use derivatives to hedge their foreign exchange risk. They use derivatives to hedge their raw material risk. So they're using derivatives all the time to mitigate business risk, not increase. And similarly, in the stock market context, you can use derivatives to reduce the overall risk profile of the portfolio rather than increase it. So again, it depends on how you want to use derivatives. To increase risk, you get an aggressive product. If you use it to reduce risk, you get a conservative product. Uh,
Gaurav, here I just want to just ask all the attendees, can you all please use the chat box and quickly write what do you feel about derivative? Do you think it is risky or if used properly, it can mitigate risk? Just write yes or no. I want everybody to please participate in this masterclass. It is not a monologue. We want it to be very interactive. Can you all please write yes or no in the chat box? You feel derivative is a good instrument or a bad instrument? Diana, are we getting attendees writing? Yes. So, Gaurav, we are getting some feedback. I want you to see their feedbacks and maybe address their concerns first.
you want me to read the comments?
Yeah. I think chat box largely everybody feels derivative is good, right? What I understand, derivative is good for portfolio building.
I don't know what does for risk management, yes. Yeah.
Can you see the chat box, Gaurav?
Yeah, I'm seeing those. Uh,
So someone mentioned double-edged sword, need to understand how SIF funds will use derivative according to the norms led by SEBI.
No, I think that's hitting the nail on its head, which is that it's a double-edged sword. You can use it both ways. Uh, Double-edged sword has a connotation that it always will mean that even if you're using it to reduce risk, it can sometimes backfire. But I don't necessarily mean that. What I'm trying to say is that depending on how you use it, you can use it to increase risk or reduce risk. So I think, yeah, in general, I think people seem to be on the same page. So in our case, in this product, we are using derivatives to mitigate risk, and hence the product that we're talking about right now is a very conservative strategy. And from an intent point of view, our idea was that for the last 3 years, or more like 2.5 years, we've been grappling with this question on good tax adjusted returns, and the reason I say 2.5 years is because 2.5 years ago is when the taxation on debt mutual funds changed. Before that, a debt mutual fund used to be a good way to, gain exposure to relatively moderate return, but with extremely low risk. And then, if you are a growth investor needing higher returns, then you obviously used to go to equities. But after that taxation change, I think to get respectable post-tax returns with low risk has become a challenge, because debt after tax becomes a very suboptimal return number. People have moved to funds like equity arbitrage funds, but equity arbitrage funds are more like, you know somewhere in the vicinity of 6 to 7% returns, 6.5% or so returns on a pre-tax basis. On a post-tax basis, that also falls to below six. And then if you need respectable inflation beating returns closer to 8, 9% or so, then you directly make that switch towards equities. Equities usually deliver 11, 12% returns, which helps in beating inflation, tax efficiency, but obviously they come with a high degree of variability. So we thought this was a big gap, that on one hand you had products like equity arbitrage and debt, where you were getting a lot of stability in returns, but not very high returns, even after taxes. And on the other hand, you had equity where returns were high, but there was a lot of risk or variability in those returns. Which is in between, where there is promise to generate debt plus returns, and obviously debt plus would mean arbitrage plus as well, but with equity taxation. So debt plus returns, equity taxation is what our intent was. And that's how we're trying to use derivatives here to create a conservative product which can achieve that, generate debt plus returns, but with equity taxation. And with that, I go back to the point on how the asset allocation of this fund looks like. So to get equity taxation, you have to have 65 to 75% of your portfolio in gross equity, and which is what we intend to achieve here. Uh, 25 to 35% will be in debt. And then what we've also said is that up to 10% of the portfolio can be in REITs and InvITs. So that's the broad asset allocation: 65 to 75% in equity, 25 to 35% in debt, and 0 to 10% in REITs and InvITs. And that, in a way, gives you equity taxation. Within equity, a large part of our portfolio will be covered equity exposure, where what I mean by that is that we'll be using derivatives to reduce variability in returns. This is not arbitrage. We are not trying to completely hedge out equity risk. There will be some equity risk, but through the use of derivatives, we are trying to control or mitigate or manage that risk uh, on an overall basis. And then, as you can see, up to 10% of our equity allocation. So of the 65 to 75, up to 10 can be in what we call, special situations or event-driven trades, where we may or may not use derivatives to reduce risk, but most of these are going to be relatively low risk opportunities. For example, a merger between two entities, the merger ratio is announced. So, for example, stock A is merging with B, and it's announced that they will merge in the ratio of 1:1. So then theoretically, uh, stock A and stock B should trade at the same price, right? Because eventually they are going to merge in a 1:1 ratio. For one share of A, you are going to get one share of B. But it may so happen in the markets that because of liquidity, ownership, or other such constraints, stock A might be trading at 98 and stock B might be trading at 102. Now, how do you capitalize on this? You buy stock A at 98, you short stock B at 102, and that 4 rupee spread is what you capture as you move towards merger. So this is one example of what kind of trades can come in this 10% bracket. Sometimes very opportunistically, We can do certain IPOs, but again, our intent will be to sell it off as soon as we get liquidity to sell it. So even this 10% bracket will not be long-term positional calls. They will be very short-term opportunistic trades. Some of them can be very low-risk trades like special situations, merger arbs, open offers, buybacks, and so on. And a very small portion within this 10 can be towards IPO opportunities, where again the intent will be to sell it off on listing rather than continue to hold it from a long point of view. So that short-term mispricing is what you're laying on.
So, Gaurav, just to understand this better, sorry I'm talking in between, but I just want if you can give some, let's say, historical case study on this part, how these opportunities were available in the past and how this fund would have encashed the opportunity like that. That would be very helpful.
Yeah, so for example, when HDFC was merging with HDFC Bank, you had a pre-announced swap ratio. Uh, but practically, there was a difference in stock prices versus the announced swap ratio. So what you could have done is to buy, let's say, one, which is HDFC, and short another, which is HDFC Bank, and play for that spread. This is something that conventional mutual funds cannot do. The reason they cannot do is because when you buy HDFC and short HDFC Bank, that short HDFC Bank trade is an unhedged exposure, right? And that is not something that you can do. But in an SIF, you can do that. And then there are trades like open offers, right? So especially in stocks which are in futures, uh, if there is an open offer at a certain price and the stock today is trading at a discount to that, you buy it and you tender it in the open offer.
Yes.
But in the open offer, a certain portion of your shares will get accepted at a higher price. Not all of these shares, right? So, for example, if you own 100 shares and your expectation is that 10 of these 100 shares will be accepted at that higher price, then for the remaining 90, you short futures, and that's how you try to manage your risk and earn that extra sort of premium on the remaining 10% in a very controlled risk fashion. So I think these are some examples, and there are umpteen number of such examples on buybacks, dividends. uh, Dividends, not so much, but let's say buybacks, open offers, merger arbitrages, etc. That you can explore. And again, this is not something that may be available at all points in times, and which is why we said that this will be up to 10%. But whenever this is available and it's giving good risk-adjusted returns, that's something that you want to play as well. But this is a very small portion of the 65 to 75. The remaining 55 to 75, depending on whether you are a 0 or 10, is what we call covered equity exposure. Uh, Before I come to that, just to cover off the debt and reach and invest piece, on debt, duration or credit risk. So in all likelihood, we'll restrict ourselves to papers which are rated AAA or, for that matter, government bonds, and usually with maturities less than 3 years. So to that extent, we are not exposed to a lot of interest rate risk, and we are not exposed to a lot of credit risk. So this will be relatively conservative allocation on debt. And then we can add REITs and InvITs to generate some extra returns, because REITs and InvITs can typically yield double-digit IRRs also. But you have to make sure that a lot of that allocation is backed by front-ended cash flows, so that the certainty around getting the deal increases. So think of it as one third of the portfolio being in REITs, InvITs, and debt. The remaining two-third is in equity, of which a very small portion, not exceeding 10%, is the kind of trades that I talked about around short-term event or opportunity-driven trades. The bulk of the portfolio, however, is what I call the covered equity exposure, and where I'm saying that we buy cash equity, but we use derivatives to manage our risk profile. Now, how do you use derivatives to reduce risk of an equity portfolio? I think if you think of it theoretically, one simple way uh, to protect anything is to buy insurance against it. And in the stock market context, protecting equity the insurance counterpart is buy put options. So if you buy put options, if markets decline beyond a certain point, your losses get limited. Um, so it's a good way to protect your portfolio from extreme events. But the problem with buying put options is the same as buying insurance, which is that you have to keep paying a premium every time. And if, for example, to protect a stock, if you have to pay a 1% premium every month, on a 12-month basis, you would end up paying 12% premium. Now, 12% for a year, if you end up paying, and in most cases, your expectation from equities is to generate 12% return, then this is not a great decision to make, right? Where you're buying something to generate 12% and you're paying 12% to protect it. So, which is why buying puts is a good theoretical concept, but practically it's very difficult to do because of this premium that you have to keep paying. The other way people use derivatives around their base equity allocation is to sell call options against it. And I think a lot of HNIs do this. And what this essentially means is that let's say you own the stock at 100, you sell a call option at 103, and let's say you earn 2% premium. Now, if the stock stays at 100, you keep earning that 2% premium. So it's a good way to, earn premium. In the earlier case, we saw that to buy a put option, you have to pay a premium. Here, you are actually receiving a premium, which works very well in a sideways market. But what is the flip side? If there is a big run up in the stock price, look at this red line here. If there is a big run up in the stock price, and in this case, I said that we've sold a call at 103. Beyond 103, you will not make any incremental money because while you own the stock, whatever you make on the stock, you will lose similar amount on the call that you've sold. So that's the flip side of the strategy that beyond a point, your profits get capped. It's not that you're losing money, but your profits are getting capped beyond a point. In a sideways market, you're earning that premium. And if there is a big decline in the market, unfortunately, what happens is that while you've earned that premium, you're still exposed to decline on the base stock position. So if the market, for example, falls by 20%, while you would have earned 2% premium by selling calls, you still lose 18% on the overall portfolio, right? Because stock tanks by 20%, you get a 2% premium benefit, you still lose 18%. So again, this is a good strategy for a sideways market, but not something which works well in a sharply declining market. And similarly, in a sharply rising market, it sort of caps your upside. Uh, Now, if you combine these two strategies, right, buying a put, which means paying a premium, selling a call, which means earning a premium, then this is what the payoff looks like. If you look at the orange line here. So essentially, the problem with buying a put option was that you had to pay a premium. So if you own the stock, you buy the put, and to fund that premium, you also sell a call option against it. Now, what happens with this strategy is that if the stock runs up too sharply, your profits get capped at certain point because you've sold a call option there. But if the stock declines sharply, your losses also get capped at a certain point because you've bought put options there. So in a way, both significant upsides and significant downsides get eliminated. And your payoff essentially moves in a range, depending on where you have sold the call and where you bought the put. And again, if you can manage your call and put position such that you sell a call which is closer to the current stock price, then you'll end up earning a higher premium there. And if you buy a put which is slightly away from the stock price, then you will have to pay a lower premium there. And on a net basis, you can still earn some premium, right? So if the stock is at 100, if you sell a call at 103, the premium that you will get will be X, let's say 2 rupees. But if you buy a put not at 97, which is again similar distance to 103, but you buy a put at 94, which is slightly further out, then your premium paid may be lower, let's say 1 rupee. So you got 2 rupees from selling the call because you sold a call which is 3% away. You paid 1 rupee to buy the put because you bought a put which was 6% away. On a net basis, you earned a 1% premium. Now, what happens in this case is, A, as I said earlier, you've reduced variability in returns because you don't make money beyond a point and you don't lose money beyond a point. And for the sideways market, you also have earned some premium income. So now when you think of this entire, and let's say, whatever I talked about with respect to the, whatever I talked about with respect to the equity allocation here, which is covered equity exposure. Let's say if you do this on that entire portfolio, then if you think of this portfolio in its totality, it has three components. One third of this portfolio is debt and reach and invest, which is yielding some stable yield every month. Two-third is equity. Within equity, there are two components. One is the options premium that you're collecting net of the call that you sold and the put that you bought. So you're earning some premium income from there. And then the third piece is the equity portion itself. As I said, you're reducing the variability in equity returns, but for slight up moves, you will make some money. For slight down moves, you will lose some money. You'll never lose a lot of money. You'll never make a lot of money. But within that band, you can potentially make money and lose money. So there
So,
are these three
Gaurav,
components.
Gaurav, just one point. It seems like a lot of data, a lot of numbers, and all coming in. My request for everyone, can you just quickly write on the chat box? Have you understood what Gaurav just explained? Can you write yes or no, please? Because we want this to be understood well, right? If you are trying to understand this concept, can you quickly write on the chat box yes or no on this last exercise what Gaurav explained? I can't see anyone writing in the chat box. So, Gaurav, somebody mentioned partly understood, but execution is key. People have concerns on execution, uh, and I think people understood. Partially yes, partially no. So, I think most of the people are able to understand that. On the execution risk, Gaurav, can you explain how does this work?
Right. So just to clarify, we are doing it on the same stock, right? So we are not sort of hedging Reliance by HDFC Bank puts or something of that sort. So by hedging HDFC Bank, we are buying Nifty puts. This is at the same stock level. So very simply put, what you're saying is, I want to buy protection, but to pay that premium, I'm also selling my upside. Right. So
Right.
I want to buy downside protection for which I'm happy to sell my upside such that I will make lesser returns on the way up, but I also want the piece that I lose less money on the way down. And that in a way makes it a controlled payoff. Execution is key, yes, because what you need is liquid options. And if you think of the FNO markets today, you have futures and options on a little over 200 stocks as we speak. But when you think of liquid stocks, I think that universe will come down to some 75, 80 names. When I
Okay.
say liquid, I'm talking about liquidity in options also. I think that universe will shrink to 75, 80 names. And and when you think of 75, 80 names, there's a good chance that a large number of those stocks will be large caps. There'll be some mid caps which will also be very liquid. But broadly, you're talking about the large cap universe. So to that extent, I think this is a good point that execution is important, and which is why, you know, practically you will see that there is a very high skew towards larger companies in this portfolio. And in any case, the intent is to generate conservative returns here. And to that extent, I think having more exposure towards large caps is not something that necessarily takes away from the intended risk reward outcome. But when you think of these 75, 80 names, I think they are very liquid. Some of them are massively liquid, some of them are decently liquid, but I think you have a good universe available there. Uh, from our point of view, we eventually need to or want to create a portfolio of somewhere in the 25 stocks ballpark, maybe towards 30 at max. So somewhere closer to 25, 30 stocks. So then within the 75, 80, again, depending on our view on these stocks, where we see potential upsides and so on, and given the liquidity profiles and how much premiums are we getting from options, we'll pick and choose a universe of 25 to 30 names.
Gaurav, I think there are some questions which are coming in. Can we take these questions as we talk, because it
Yeah,
will
yeah,
be
sure.
very relevant, because it's very different masterclass than our earlier ones, because a lot of numbers you are throwing in right now. So I think people are want to understand it better. So question is, this is like having an online monitoring system, fault finding and real time corrective actions being taken. Is that correct, Gaurav?
No, no, no. So think of it like, you buying something that you like, right? Buying a stock that you like. But you also want to make sure that you put enough guardrails around that position so that even when you get it wrong, you don't lose a lot of money. So to that extent, it's like you're buying something and you're buying protection against it, and you're also selling the upside against it. So, so this is like any other, active equity fund, but with this overlay of the derivative structure. So to that extent, this is not something where you are, worried about what happens to the stock price on an intraday basis, or this is not a very high frequency driven trading. This is something where you're buying 25, 30 good companies that you like, and then through the use of options, making sure that you don't lose a lot of money. And the flip side to not losing a lot of money is that you'll also have to compromise on the upside. And the way you do that is to buy a put option against that position and also sell a call option against that position.
So one question, Gaurav, which is coming, what will be the percentage of equity that will not be hedged at all? What I understand is 10% to the max, right?
Yes, 10% max. And within this 10% also, as I was saying, none of it is long-term positional exposure. It's not that, I like a stock which is not in FNO, so let me just buy it within this 10% and sit with it for the long run. This 10% also, as I explained earlier, is largely, events, special situations, maybe some IPOs, but those IPOs, again, you exit as in when you get the liquidity to exit and so on. So to that extent, this is all opportunistic, event-driven opportunities. Even this 10% is not long-term positional stock holdings.
Gaurav, one more question is regarding India is structurally a bull market. Last 10 साल में हमने one side ही देखा है market को. I know there have been times when markets went down. So in a market which is structurally a bull, we are talking about India becoming Amrit Kal in 10 years, 15 years, 20 years. I know as a fund manager you must be using it at many times, but using short in your strategy, can it go seriously wrong? I think what are the ways you feel it can be like investors should be aware of those risks?
Right. So I think the first and foremost point is that when you think of a category like equity arbitrage funds, that is, I don't know what, a 2 lakh crore plus category now.
Right.
So, even with all this optimism about long-term prospects of Indian equities, people are looking for avenues like equity arbitrage, right? And the reason they are doing that is that all of us in our portfolios need some allocation to assets
Right.
which can, with a very controlled risk, uh, in a very controlled risk fashion, they can help us beat inflation comfortably over long periods, right? So we all have that pocket. Not all of us are putting all of our money in growth assets like equities where we are okay to lose 25-30% in a year also. We all have some portfolio earmarked for relatively stable returns where we can comfortably beat inflation but without a lot of uncertainty around meeting that objective. And which is why you're seeing that after the taxation on debt changed, you have had this massive move towards equity arbitrage funds. So I think to that extent, you shouldn't directly just compare it with equity funds. Uh, and uh, and the way we think about products is through this ladder. This is a simple ladder which looks at risk and return together. Uh, so the way this product is positioned is that on when you look at the rightmost part of this slide, these are all equity funds which are supposedly uh, higher return but higher variability products. Then you have mutual fund hybrids, like dynamic asset allocation, balanced advantage funds, and so on, which mix equities with debt to reduce the variability in returns, but also sacrificing some amount of absolute returns. And then on the other hand, you have arbitrage, which is absolutely safe, but with extremely low returns. So our idea was that uh, we want to create something which can bridge this big gap. Because a lot of money is coming in arbitrage today and is sitting there for a year, 2 years, and so on, because that money doesn't have the risk appetite to go into equity assets. They don't want to go into debt funds because of taxation, and so they are settling for 6.5 pre-tax returns that arbitrage usually gives. So our idea was that can you give them a return experience which is higher than arbitrage, which also will mean that there is a slightly higher variability around those returns, but the overall risk of that portfolio should be lower even versus hybrid funds on the mutual fund platform. So that's where the risk reward positioning sits. So irrespective of what our views on different assets are over long periods, we all want these various pockets in the market in our portfolios. For a conservative investor, this piece will be a large part of their allocation. For an aggressive investor, this piece will be a large part of their allocation. But each investor will have some combination of the entire spectrum. So I think that's how we sort of approach product construction in general.
Right, right. So there's one question. I understand put and calls will be only on the long equity purchase. Have I understood this correctly? I think is this is
Right, so I think very good question. So what I did not cover is the fact that we can also go shorts. We can also go short, right? So what I talked about is that we buy stocks and then we use this structure, right? We uh, buy put for protection, we sell call to earn premium, lose upside, but also protect downside. Now, what the fund allows us to do, SIs allow you to do, is to also do shorts. Now, what that essentially means is that I may not be owning a particular, let's say, XYZ bank, but if my view is that XYZ bank will fall, I can short it in futures and benefit from the price decline. But there again, to keep the risk profile in check, what we will do is to use derivatives to mitigate risk even for that short position. Now, when you're short on something, what is your risk? Your risk is that the stock will shoot up, right?
Hmm.
So when you're short something, you benefit from stock declining. Your risk is that the stock will shoot up. How do you manage that risk of stock shooting up? You buy a call option, right? So you buy a call option at a certain price away from the stock price, such that beyond that point, even if the stock keeps rising, you don't lose money because whatever you lose on your short position, you make similar amount on the long call position. So this is exactly the opposite of what we were doing earlier. We were buying put there. Now we are buying a call to protect from in a short position. And then to earn a premium, what we do, we sell a put option against it, right? Because a put option is intended to be a play on declining markets, and you're already short on the future. So if the market declines, you'll anyways benefit. But if you sell a put option at a certain point, you will stop benefiting beyond that point, but at least you'll earn some premium. So what we were doing earlier was buying a call, sorry, selling a call, buying a put against a long position, and that was creating this band around our stock position. Now, because we are short, we are buying a call as a risk mitigant and selling a put to earn premium. And again, we are creating a band around that short position. So yes, opportunistically, we will be using the short leeway. But there again, our intent will be to control the overall risk of the position through the use of options.
Thank you. So, Gaurav, I think before we move forward, I know it's already 1 hour. We are just putting one feedback form in the chat box. My request is before anyone leaves this room, please update the feedback form because we need your feedback to understand if you understood this concept well. In case if you want to understand for a 30-minute call or a 45-minute call, very happy to take it forward. So kindly fill up that feedback form, please. We'll wait for 30 seconds before we again start. Once you fill the form, please write yes on the chat box, please. Guys, we are trying to experiment this time with more कॉन्वर्सेशन विथ ऑल ऑफ यू, बिकॉज मैंने देखा है कि नॉर्मली हम सेशन लेते हैं तो बस इनहेल करते हैं, एक्सेल नहीं करते हैं, पीपल आर नॉट रिस्पॉन्डिंग, so that makes the session very difficult for the speaker. So we want to make sure it is valuable for you. So kindly put your feedback, please. Sorry, Gaurav, to interrupt you. Sorry
No,
for
no, no,
that.
that's fine.
Yeah. Please kindly fill the feedback form. Yeah. So, Gaurav, there are some other questions also which are coming in. And I think one is we have strategies in SIF either through SBI and other fund houses who going forward will compete with long only equity, because I think that's a very favorite topic, and will be better solution against PMS and AIF. Or shall we rule out that expectation out fully? You feel this is a good expectation to have?
No, sorry, strategies which are more aggressive, is that the interpretation?
Yes, that's correct.
Yeah, so I think if I talked about those several categories at the beginning, right? These categories that are there. So I think this is one category where you can do a lot more conservative stuff. And we started with this category because of that gap that we saw between what arbitrage can deliver versus what equity funds deliver, but the risk associated and so on. So our idea was to fill that gap first, because today we see that a lot of money is looking for debt plus returns, but with equity taxation. And there are not that many avenues where you can get it. So we thought that that was the first gap to fill. But when you think of other categories, for example, all of the equity categories will be very aggressive. So maybe, some of these categories will compete with mutual funds. I, for example, talked about the sector long short fund, right? Uh, this will be, I think, one of the most aggressive categories, and if you do it well, will be a significant value add versus the conventional business cycle funds that you see on the mutual fund platform. The second category here can actually be a good competition to PMSs, right? Which is the non-top 100 long short. The equity long short itself, depending on how you structure it, can be a competition to a long only mutual fund or to an absolute return oriented AIF. As it is, the fund that we are talking about, we think is at least in our view, is a good alternative to long short AIFs, because it's generating that steady inflation plus debt plus kind of a return with better taxation and with decent degree of stability. So I think we started with a conservative product, but very soon even the active asset allocator long short, right? Let's say you're taking active views on commodities, it is by definition going to be aggressive. So I think yes, we started with a conservative approach because we thought that that was the biggest gap in terms of return, risk return, positioning of different products in the market today. Uh, which again, to repeat myself, is getting debt plus return with equity taxation. But all other categories that you will see going forward are going to be significantly more aggressive than this. Some competing with the mutual funds, some are even competing with PMSs and AIFs.
Understood. Again, in terms of transparency as well as governance point of view, so I know SEBI focus is on fiduciary oversight, right? How does this SIF ensure operational transparency? For example, how often the valuations are audited and what kind of investor disclosure is mandated here?
No, so I think from a regulatory risk framework, communication, transparency, I think it's going to be almost the same as a mutual fund, which is that we have risk templates that we have to adhere to. Just like we have to do for a mutual fund scheme. We have an investment committee that oversees the entire decision making that happens in the fund. We obviously have all the compliance checks to make sure that we are compliant to the regulation. From a communication point of view, obviously there will be a fact sheet just like there is for mutual funds. Uh, there is daily NAV here. While this is classified as interval category of funds by SEBI. So to that extent, you can only have two redemptions a week. That is SEBI's definition. But NAV will be published daily. Subscriptions can be daily. We made sure that there are no exit lows beyond 30 days. So to that extent, that is, I think that's why I started this conversation by saying that from a disclosure point of view, from a regulation point of view, from a governance point of view, this is just like any other mutual fund scheme. But obviously, this is classified as SIF because you're using more flexibility around derivatives, and to that extent, the regulator wants it to be differently named and positioned than a conventional fund, so that a retail investor can make the right choice. But from every other standpoint, this is as good as a mutual fund scheme.
Again, from a fitment and suitability point of view, I know, Gaurav, that is a answer I, as an advisor, need to take care of. But still, from an experience so far, which investor profile best fits from SIF? I know there are different categories. HNIs with tactical capital or long-term goal-based investors seeking managed exposure.
Right. So the way we think about this product is that you should expect uh, a slightly higher variability in returns than an arbitrage fund. But if you hold the portfolio for uh, anywhere between 18 to 24 months, I think that is the right time frame to look at for a fund like this. Arbitrage, I think people usually look at from a 12-month time frame. Most equity related products, people you look at it from a 3-year plus time frame. I think here is the in-between space where you look at it from an 18 to 24-month time frame. And over that period, we think that variability in returns will be quite low. And that said, uh, you have all the avenues available to exit. So this is not a risk-free product. There can be some volatility in between, but after an 18 to 24-month point of view, that should take care of itself. But if you need your money at any point in time, this is equity taxation. So if even if you need your money in 6 months, you get out at 20% tax. Beyond 12 months, you get out at 12.5% tax. Because this is a controlled risk product, there'll be some drawdowns in the strategy, but those drawdowns are going to be meaningfully lower than an equity fund. So to that extent, the risk of losing a lot of money when you want that money and you're redeeming it is low. Uh, Thirdly, as I said, from a liquidity point of view, there is no exit load beyond 30 days. There is twice a week redemption. There is daily NAV. So from a liquidity point of view, also it works. So think of it as 2-year allocation in a debt plus return strategy with all the flexibilities associated to get out when you want, including equity taxation.
Understood. Understood. So again, a little forward-looking view, Gaurav. What do you think 5 years from now? Where do you see SIF in India investment landscape? Anything you can foresee that what all things will come in and how is this industry going to pan out?
I mean, to be honest, on this point, my guess is as good as you or anyone in the audience. But I do think that and I hope that this is just the beginning, which is that the regulator, the market participants, investors, AMCs, everyone, they're just sort of starting to experiment with more sophisticated products on the mutual fund platform. And if you look at the Western markets, you have so many different uh, kind of products which allow you to express your risk reward in several ways, including from being very conservative to very aggressive. There are uh, things like leverage ETFs and whatnot. So I think this is a step in the right direction where you are not completely opening the tap but still experimenting a bit versus conventional mutual funds in terms of uh, more flexibility on derivatives and so on. But I think, and again, something that I've already covered is that it allows you to create risk reward characteristics which are very different from mutual funds, because mutual funds are beta products, right? They are dependent on the underlying asset doing well. And on top of it, there is a degree of alpha, but the core of their functioning is that the underlying asset does well. Versus which having relatively low correlated returns to the underlying asset is something that is to us the main attraction of an SIF. And to that extent, I think if you have conservative products somewhere in between. then I think this can be a very big industry. And then I'm also not ruling out, I'm also not, it can be a very big portion within the mutual fund industry, but I'm also not ruling out, uh, depending on how the initial suite of products gain acceptance and success, I'm not ruling out further sort of change in regulatory landscape to make even more sophisticated category of products available on a transparent platform like mutual funds.
Right. So I think we are coming to end of it. Last one or two questions. Before that, we have received some feedback forms, but not from everyone. Request everyone to please fill up the feedback form. Our request is because it's a very complicated subject. So we feel that unless we don't educate ourselves well, we'll not be able to do justice with it. So kindly fill up the feedback form. So again, Gaurav, a question for you, which is coming up is with SEBI allowing differentiated wrappers like MF, PMS, AIF, SIF, do you see a convergence where investors use all four strategically based on their goals, tax profile, and liquidity buckets? You think for investor it's a very great opportunity to build a portfolio under the regulated umbrella everywhere because there is a lot of stock picking which investors keep doing at times, and I have seen them. This is a lot of FOMO which drives them to pick up all these things, right? With all these things coming in, do you see lot of that converging now in these organized structures going forward?
No, no, absolutely. I think that clearly is the intent on part of the regulator because what you're seeing, for example, is a lot of action in derivatives market, right? Some of that is investors themselves doing something in derivatives. Some of them is investors, uh, having this FOMO of being in derivatives but not having the required skill set. So they're going to some of these relatively unregulated entities and asking them to invest on their behalf because AIF we all know is not everyone's cup of tea, right? Putting 1 crore in a single scheme with a lot of illiquidity and so on is not something that everyone can do. So to that extent, some of this demand was getting fulfilled through unregulated channels, and which is what the regulators said that there is demand. Let's reduce that ticket size from 1 crore to 10 lakhs for SIs and do it in a structured fashion through relatively more specialized managers. And you're right. I mean, eventually, when we think of our long-term wealth creation journey, any individual for that matter, it's very less about picking that one or two right stock. It's more about how well have you allocated your portfolio across uh, you know diverse assets which give you that intended risk reward that you're aspiring for from a longer term point of view. And to that extent, and I think there's a lot of research around this, that the right strategic asset allocation is what matters more for an investor's long-term wealth creation than picking that then the right stock at the right time or market timing or any such things. And which is, if you can have different silos or different pockets in the portfolio where we can clearly earmark that this is my risk appetite, this portion of my portfolio will be towards growth assets, this portion of my portfolio will be towards stable inflation beating assets, within which, this much of my portfolio can be towards illiquid assets like, let's say, AIFs, private equity funds, and whatnot. This much of my portion has to be in growth assets, which are more liquid in nature, like, let's say, equity mutual funds or PMSs for that matter. And within the other bucket, then again, you can do how much of my money should be in SIFs or a conservative strategy, how much of my money should be in an arbitrage fund. And, I think that entire laddering will allow you to not just do justice to long-term wealth creation, but also the discipline to sit with it for a longish period of time. Because at times we all do some sort of an asset allocation for ourselves, but it's so skewed one way or the other that very soon, we start losing our sleep over that asset allocation, and hence we don't really see the long-term merits of it because we tweak it at the wrong time. So I think this structured approach on keeping these four silos and then thinking about it, I think will definitely help. And in that sense, the more the kind of products with different risk reward profiles, the better it will be to fill the portfolio. Then obviously, distributors like you will have to sort of do that final customized solution basis the client's needs. But I think it does sort of say be allowing so many different categories does make that job so much easier for investors and distributors.
Thank you, Gaurav. And it was amazing. I personally learned a lot, and I'm sure all of us learned something from this. And I think this will require a follow-on session also. So I think looking forward for that. So again, for all of you, thank you very much for being such an engaged and curious audience. I hope today sparked some new ideas and perspectives for you. And I feel knowledge is powerful, but action is what create real change. Take one thing from today and put it in practice is what I say. Thank you very much and good evening. Thank you very
A
much.
pleasure. Thank you so much.
Thank you very much.